All right, let's jump right into this explainer and systematically dismantle the outdated financial advice that is literally costing you money right now. With inflation acting completely unpredictable and U.S. household debt soaring toward $19 trillion, we have to look at the new math for 2026. And honestly, to get there, we need to clear away decades of outdated conventional wisdom. Because if you're still relying on the classic 4% rule or listening to the biggest names in personal finance who peaked in the 1990s, your wealth building strategy is likely leaking serious capital.
I want you to really ask yourself, is your financial blueprint mathematically obsolete for 2026? It's incredibly frustrating, isn't it? You do everything right. You follow the famous advice, but you still feel like you're playing a modern, high-stakes game using a rulebook written way back in 1997. The economic landscape has completely shifted beneath our feet, but the loudest voices in the room, well, they're still shouting the exact same catchphrases.
Let's ground this struggle in some hard data. $18.8 trillion. By the end of 2025, U.S. household debt hit a staggering $18.8 trillion, with credit card balances alone sitting at $1.28 trillion. So when some motivational guru tells you to simply stop working for money and suddenly become an investor, it just violently collides with a very brutal modern reality. A massive number of people out there aren't choosing between job income and asset income. They are standing on the edge of exhaustion, just choosing which bills to pay. The modern economic terrain is totally unforgiving, and simple platitudes just won't cut it anymore.
Section 1. Myth-busting the gurus. What they told you then versus what the math says now.
Look, being financially literate in 2026 means knowing exactly which famous financial advisors you need to ignore, and more importantly, why the math says you should ignore them. Ironically, Robert Kiyosaki, the author of Rich Dad, Poor Dad, notes that a person can be highly educated, professionally successful, and financially illiterate. It's actually a profound statement, and it applies perfectly to anyone who blindly follows his outdated advice today. Rejecting modern wealth-building tools just because a book from the 90s told you to? That's the real mark of financial illiteracy in 2026.
Let's actually compare Kiyosaki's claims against modern reality. He famously tells his followers to avoid mutual funds and 401ks, labeling them as too risky. But financial analysts like John T. Reed completely dismantle this. Broad-based, low-cost index funds like the Vanguard 500 carry virtually no risk other than the entire global market collapsing. Plus, by ignoring your 401k, you are literally throwing away massive guaranteed tax benefits. In today's economy, walking away from tax-advantaged accounts is basically like tipping the IRS just for fun. It's not savvy, it's financial self-sabotage.
And Kiyosaki definitely isn't the only one. Take Dave Ramsey. Ramsey built an absolute empire getting people out of debt, which, hey, is fantastic, but his investing advice is dangerously outdated. He routinely expects investors to pick active mutual funds that outpace the S&P 500, and he often quotes these super aggressive 12% return rates. But juxtapose that against the Boglehead's proven passive investing strategy. The data is crystal clear here. Past performance and expensive active managers do not reliably beat the market. Keeping your costs low is a far better predictor of long-term success than any active stock picker out there.
And this right here brilliantly exposes the hidden cost of that bad advice. If you use a Ramsey-endorsed SmartVestor Pro, you are often looking at total fees of 2% or more, combining assets under management fees with hidden mutual fund loads. And crucially, they aren't even required to be fiduciaries. Contrast that with a low-cost, fee-only advisor who acts as a fiduciary 100% of the time, often charging less than 0.6%. That fee difference will literally cost you hundreds of thousands of dollars over your investing lifetime. No joke.
Section 2. The 2026 Macro Reality. Let's put the cost of living in focus. So if the gurus are getting the execution wrong, what is the actual landscape we're dealing with? Well, you know that old 50-30-20 budget rule, spending 50% on needs, 30% on wants, and 20% on savings? Yeah, it needs a serious overhaul because the fundamental cost of just staying alive has shifted. While 2026 baseline grocery inflation is projected at a relatively modest 1.7% by the USDA, the Social Security cost of living adjustment actually sits higher at 2.8%. This tells us that the baseline fixed cost of simply surviving and maintaining your standard of living is still creeping up much faster than the headline grocery numbers might suggest. But here's the thing. The baseline is definitely not the whole story. The USDA projections actually have a massive margin of error for 2026. They estimate inflation could swing anywhere from negative 2.3% all the way up to 6%. Why? Because of what industry experts call the X factors.
We've got extreme weather disrupting coffee, sugar, and California produce. We also have 50% tariffs on steel and aluminum imports from China and Canada, which heavily drives up the cost of food packaging and processing equipment. And finally, cattle inventories remain at historic lows, meaning beef prices are going to stay stubbornly high. This is the volatile reality your budget absolutely has to absorb.
Section 3. The New Math. Let's look at your 2026 blueprint.
All right, let's talk solutions. We start with the first unshakable pillar of modern wealth building, $24,500. That is the new maximum contribution limit for 401ks in 2026. Seriously, ignore the gurus who tell you to walk away from paper assets. Maxing out this space, or getting as close to it as your income allows, is mathematically the absolute most efficient way to lower your tax burden while capturing that sweet compound market growth.
And right on its heels is $7,500. This is the 2026 Individual Retirement Account, or IRA limit. So between a 401k and an IRA, you have $32,000 of perfectly legal, government-sanctioned tax shielding available to you this year. It's the boring, unsexy, but mathematically guaranteed way to build a multi-million-dollar net worth over time.
But what if you want to retire early, like the FIRE movement advocates? You can't touch those retirement accounts without major penalties until you're 59 and a half. So this brings us to the crucial missing link, the bridge account strategy. This simply means aggressively funding a standard taxable brokerage account heavily invested in low-cost index funds. This account acts as your bridge, providing the liquid cash flow you need to live on from the exact day you quit your day job right up until you hit traditional retirement age. Now, managing how you pull money out of that bridge account is absolutely critical, which leads us to this massive warning. Beware the 2026 ACA subsidy cliff. The Affordable Care Act subsidy cliff is returning, guys. If you're an early retiree living off your investments, your healthcare premiums are tied to your taxable income. If you realize just one single dollar of income over the designated threshold, you lose your subsidies completely, and your healthcare premiums could instantly skyrocket by thousands of dollars. Managing your exact taxable income in 2026 is literally a matter of financial life and death for early retirees.
Which flows perfectly into what might be the single most dangerous piece of old advice out there, the withdrawal rate. Dave Ramsey frequently suggests you can safely withdraw up to 12% of your portfolio in retirement. 12%. Actual financial analysts and early retirees will tell you this is a total delusion. In today's volatile, inflation-prone environment, the classic 4% rule is no longer a static guarantee either. Many modern retirees are actually being forced into a highly cautious sub-3% withdrawal rate just to ensure they don't run out of money. If you plan your whole life around a 12% withdrawal rate, you are setting yourself up for bankruptcy, plain and simple.
Now, to be fair, while the guru's specific technical advice on mutual funds and withdrawal rates is just completely outdated, their foundational philosophy sometimes still holds up. The timeless mechanism of wealth creation remains exactly the same. Minimize your liabilities and shovel your cash flow directly into the asset column. You want assets that grow and generate cash. It's just that today, the smartest asset column isn't necessarily a highly leveraged real estate empire. It's a perfectly optimized, low-cost, tax-advantaged portfolio of index funds.
So there you go. You now have the new math. You know the updated limits, you see the hidden fee traps, you understand the true inflation reality, and you've got the bridge strategy to get you to financial independence. It is time to stop relying on 1990s nostalgia. The environment has totally changed, and your strategy needs to change right along with it. So how will you execute the 2026 blueprint and rewrite your financial future?